Hi, I'm Sam Spring, CEO of Kincora Copper. Kincora is an active project generator, explorer focused on true copper gold tier 1 discoveries. Having shifted our funding strategy to an asset level funding model in the last 12, 18 months, we've now done 5 recent deals for 5 of our 12 large-scale porphyry projects. We're now unwrapping exploration, ramping up. Late last year, we did 7,000 metres of partner-funded drilling. Further deals for our more advanced projects and further larger drilling programs are expected. And it's great to have the opportunity, Matt, to run you through it.
Well, let's talk about that, because I think a few companies have kind of switched to this model just to survive in what has been a really tricky kind of retail investment market over the last 3-4 years. So let's go back a step. So the history of this company as well, because it's been around for a while, right?
Yeah, we have been. We've been consistent hunting copper porphyries. And obviously copper porphyries take time. They're relatively capital intensive to a number of other different commodities. How do you get your funding strategy right so that your shareholder at the listed company level has a good chance of making multiple return?
Okay, so have you gone about picking up the projects that you've got? You talk about 12 projects in the portfolio. 5 of them, did you say 5 of them partnered up at the moment? If you got partners for 5 of them?
That's correct. Our earlier stage non-core ones initially, but you're right, we've picked those up. Our focus really shifted to New South Wales, Australia in 2019, 2020. We've picked up a big district scale position in New South Wales, the Macquarie Arc, which is Australia's foremost porphyry belt. We've got a very good team that's got experience in that region. But the key thing, obviously, is how do you fund these projects? We did a couple of 1,000-metre drilling program at our Trundle project early 2023. Got some pretty good results, didn't move the needle from a share price perspective, didn't move the needle from a project level.
Right, but I think it's important to explain the model properly to investors. So normally they think, right, you've got an asset, you raise some money, you kind of work it up through the economic study phases, and then you go and raise some money to build things easy, right? Here we found that it's been hard, money's been hard to come by in the sector for sure. But here you're with 12 assets in a portfolio. You've got to work them up to a certain stage before bringing in a joint venture partner. So let's look at how do you go about finding them and then funding those for a start.
Well, I think the interesting thing, Matt, is we were drilling and getting some good results, getting some interest from the majors, and we had an inhibitor, a roadblock to those conversations because we already had an asset level partner. A number of the projects in New South Wales, we bought off another listed company. They had a carried interest level at the asset level. What we did 12, 18 months ago was flip them to the listed company level. That created room at the asset level. And that's where we've been able to do 5 deals subsequently over that period to bring in asset level partners. And instead of in this poor market, probably having to shrink the portfolio, what we've actually been able to do in the last 12 months is pick up 4 projects. One of those we've already brought in a new asset level partner for. So that change in funding model to what is more of a typical Canadian project prospector generator model has enabled us to sort of pursue counter-cyclical growth. And now we've just started to get some of that third-party funding coming in.
Okay, but prospect generator suggests a very different kind of model to just, JVing, because you'll have to spend money and work it up to a certain point. Are you out just staking property, or do you work it up and do some drilling or try and hand them some data with which to kind of move forward? What's that look like?
It's a bit of a mix within the portfolio. So of those 12 projects, some are really early stage, never had a drill hole put into them. And then some of them, say our Trundle project, we've put $13 million of Kincora shareholder money into drilling that project. So there's a raft of different stages, different risk profiles. And what we've really tried to understand is what are the partners out there that could fit the different projects? And you're never going to get order perfectly right, but what we've been able to do to date is really focus on doing deals with some of those earlier stage high risk projects while we've worked, and it sometimes takes a little bit longer to get those flagship, more proximal to mine, known existing big mineral system projects into the right hands with the right deal structures. And those initial 5 deals we've done has unlocked up to $60 million worth of partner funding. We saw about $3 to $3.5 million worth of in-the-ground spending take place late last year. What we're now focusing in on some of those more advanced projects like our Fairholme Trundle projects, where we'd like to think there's more value. You can see bigger spending, because they're de-risked relative to these earlier stage projects that we've already done deals for.
Right, and let's look where the value comes from, because what you're 10 million Aussie company, right? So right now, people not appreciating what you've got, maybe not appreciating the deal structure, and maybe not understanding where the value creation comes from. So if we pick one of your projects and what that deal looks like, and maybe even let's go in priority order in terms of your number one pick is what in terms of how you value your portfolio at the moment.
Well, I think the project that people are most likely focused on is we've done a deal with AngloGold Ashanti, one of the big gold producers. They're very active in this part of the belt. We've got two projects that have gone in there. One of them's had one hole put into it. Another we've drilled one hole into, so very early stage. Conceptual exploration undercover. Would be near impossible to raise capital to advance that from the public markets at the moment. But what they're looking for is a new district. You've seen, say, Vicuña, Argentina, Chile, attract a huge amount of attention because it's emerged as a new porphyry district. You've got 160 million ounces gold equivalent resource inventory in the southern part of the Macquarie Arc. You go up to the north, that goes under post-mineral cover, and it hasn't been well explored. And that's what our Nyngan and Nevertire projects are, and that's what AngloGold Ashanti is looking for. So we're looking for a new district there. What we've done in the last quarter is drill 2,700 metres, 6 holes. It's funded by them in an earn-in deal. They have the right to spend up to $50 million to own 80% of the project. We get a management fee at the moment. So if you spend $1.5 million, that's 150 grand that comes into G&A plus absorbing all the exploration costs. That's a pretty interesting model. If you end up finding the next Cadia or the next Vicuña, which is ultimately what you're looking for in that part of the belt, then for us to have gone through this down cycle, received a management fee, end up with potentially 20% of something extremely valuable, that's a pretty interesting proposition when you factor in that's for 2 of our 12 projects and trying to find partners for the other ones and have multiple projects and de-risk the company from that perspective.
Yeah, but Sam, it's mining. The what-if scenario is always lovely to look at, but the harsh realities of today are how do you kind of keep the company going? So it feels like they have the option of spending 50 million, but obviously that'll be ranked by X amount year 1, 2, 3, 4, 5 if they move along that trajectory. How do you protect yourself in all of that? Because there'll be a small part of the audience perhaps don't quite understand the model and say, well, like, you're giving away all of the upside. What's in it for us? So again, just go through that thinking of why this thing will become more and more valuable over time, and maybe how people should look at it today.
Well, I think with exploration, generally it's a numbers game. You try and de-risk and get the odds into your favour as much as you can. In this sort of portfolio of 12 projects, what we're trying to do is have multiple projects with multiple partners operational at any one time. Again, we're not going to have 12 of those that are going to turn into mines, but if we end up with 1 or 2 of those that end up going all the way through or to an advanced stage, that's how you create value for shareholders. And in the meantime, say, for example, that program that we just had at Nyngan that was funded by the AngloGold partnership in the last quarter, those results will come out relatively soon. We're just going through permitting at the moment, but we've had encouragement. You have, with this sort of nature of program, you prove the concept, then you need more money, you need more holes, and ironically, with the structure, more management fees to advance that. And I guess it's trying to find some more advanced projects, homes as well. So if we're able to have a scenario in the next 12 months where we've got $5 to $10 million worth of in-the-ground exploration and we're getting a 10% management fee for that, that goes a hell of a long way to going through this downturn without having to dilute shareholders. And it's very difficult, I guess, as an explorer to keep coming back to the same shareholders asking for further risk capital. If we can ultimately get to that outcome where we've got a self-funded model from management fees paying for G&A, and we've got 3 or 4 different projects being worked up in the course of 1 year, that just creates really strong optionality for your investor.
Okay, so let's be clear. So so let's take all projects going to be negotiated differently because the different partners will want different things out of it, and there'll be protections from on both sides. But let's take Nyngan as an example of what it could be. Right now, you're saying, look, we're protecting ourselves from dilution because we're getting a management fee, 10% management fee. If they move all the way along that process, they stay in the game and they keep drilling. But you were sort of carried through to what stage and who gets what at the end of this? If they was it a 5-year on this one, is it, or was it based on dollar spend?
It's the key. It's a 7-year deal, so the key
7-year deal. Okay.
Yeah, the key thing is really the dollar expenditure, and there's a $2 million minimum. The way we're going, you'll see that sort of come and go pretty quickly. The way to probably think of us being the operator is if we got to a stage of making a discovery and all of a sudden you drill out and then you go to studies, they've got the right to be the operator. And at that stage, it makes sense for both parties to do so, but we don't have to put our hands in our back pocket until you've got to a stage of a pre-feasibility study or 50 million being put into the project. So it gives shareholders a pretty good runway. And probably the best recent example in the Australian copper gold exploration space for this sort of model is Greatland Gold, which I guess UK investors are probably relatively familiar with Havieron and Newcrest coming in. I think when Newcrest did that deal, Greatland was valued at about £50 million, and the exploration success and excitement of potentially a tier one asset, which they didn't quite get to, drove that Greatland Gold market cap ultimately to about 1.5 billion. So that carried model can create really good upside for your investor, and there's multiple examples of that project to prospector generator model working that way.
Right. So let's just remind shareholders and potential shareholders of what's in it for them. So this is a numbers game, right? Right now, because you guys have been around for a while and had various manifestations of the company and different business models, etc. And you're settling on this one for now. The purpose of this is in a market that's flat. Let's stay in the game, like good. And I guess the thing, how many of these deals can we do? Because it's a numbers game. It's a game of chance, quite frankly, mining. And if you do this long enough, where do you want to be? Hopefully one of these partners gets to a certain point where it's created some value, and you carry it up to pre-fees or fees or whatever you negotiate in the future, depending on the project. Do you then adapt the model and say, well, let's take one of these and advance one of these models forward ourselves? The markets are covered. I think we can do this. Or is this the model going forward?
No, well, maybe to put it into context for then sort of looking forward, over the last 12, 18 months, we've done the steps to own 100% of these projects, buy out our minority partner, start bringing in investors. That's enabled us to pick up 4 more projects. So if there's further opportunities that we think we can add value by bringing partners in, we will. But the key thing is harvesting the assets we've already got in the portfolio. And we've done that for 5 projects. That's unlocked potentially $60 million of partner funding. We think that these other 7 projects that we've got should be able to unlock a quantum more than that. But of course, things take time, and we haven't, up until the last quarter, drilled ourselves or had our partners drill. So there's that. Coming back to that question about our 10 million market cap, when you're not drilling, doing deals without results coming through isn't so much a catalyst. Now that we've done some deals, we've got the rig turning, I think we're back in the game from that perspective. And I'd like to think that in that next quarter, 6-month period, you'll see initial results from these funded programs. You'll see work programs for the next stage, and we'll see some bigger deals start coming through. Once we start hopefully re-rating from a 10 million market cap, then it creates more optionality depending on where some of these deals go with some of our bigger projects. But to fast forward, where would I like to be in 6 months' time? I'd like to see us have a program that sees $5-10 million worth of partner-funded exploration going in 2025, of which we get a decent management fee. That reduces dilution. We do a couple of other deals with some of the more of these advanced projects. That gives us more management fees. It gives us more drill meters, and then it provides more flexibility to the company of, do we want to drill one of these projects ourselves? But at the moment, I wouldn't want to think about raising further capital down near these levels. We just raised 1.3 million with the second tranche of that financing being done in December. We've just got to work through and start showing that we've come out of that period of no drilling to actually having meters, having results, having numbers coming back into the marketplace.
Okay, so it's a funny one, this, because it's a case of the management fees kind of covers costs. right? It covers costs, but at least you're not diluting. That's the positive. But the kind of growth component is dependent on, what someone else's budget allows you to do to be able to find stuff. And then your job is to try and help people understand, well, here's where it starts to become valuable to us. And, if you, again, I'll go back to Ningen, where do you think people should start attributing value to you? Because doing these things is great, gives you great opportunity. At some point, it becomes valuable. But when someone's earning into, what is it? What percentage do they end up with?
Ultimately, 80%.
80%. Okay, so you get a chunk of a small part of the potential of this thing. But when you say people will start re-rating and people start valuing us, and people where does that come? I mean, how many of these projects need to start advancing to what stage before you think, actually, come on, guys, this is valuable, this is real stuff? Because again, I just felt it's one of those models. We've seen it a lot in North America. It takes a long time to manifest that value. Certainly for companies who, just started out on this business model. What did you guys buy into when you came up with it?
Well, I guess one really good near-term immediate peer for us is Inflection Resources. Inflection is listed on the CSE, ticker AUCU. It's got AngloGold Ashanti as its earning partner. Its drilling as close as 1.5 kilometres from our Ningen project. They've spent probably AngloGold Ashanti with Inflection over the course of the journey plus $10 million. Its market cap circa 20 million Canadian, so it's more than double ours. And I guess when that's their flagship project, when I look at us, Ningen's one of that 12 projects in our portfolio and one of our earlier stage ones. So why have you got that value differential? I think they've started to get results out to market. They've had some encouragement. It's a story that's now well understood, and that business model is well understood. We're in that transition phase of pivoting the business model, resuming drilling, not yet having results out to market. So I guess as a case study there, Matt, I'd like to think that, again, we're at that point where you've got to have results, you've got to have a track record in the marketplace of this business model. And we're probably one more deal away from people really going, okay, I fully get it. Kincora is not a dilute every 6-12 months at the listed company level. They've got partner funding. We can see what their budgets are. We can see these initial results, and we can see this being scalable with one or maybe two more deals.
Right. But so if we look at where is Inflection in the process at the moment, what have they done? They're drilling a lot, obviously, chasing copper and gold, but where are they? I'm just trying to understand where this 20 million Canadian comes in.
Oh, they're at the same pre-discovery phase, putting drill holes there, getting some technical encouragement. We haven't yet announced any of our results yet, so we're sort of one step before that of just resuming those programs.
Okay. So who else is involved with this project? Who works with you? Who's active rather than nameplate?
Yeah, and probably we're an exploration play, so the key thing is the technical team. Who are they and what's their track records? The two key guys from that perspective is John Holliday and Peter Leaman. Those two are the technical people in our technical committee. I'm the third member and the more commercially driven one. John's really a foremost expert in Macquarie Arc porphyries. He was the key figure that originated, led and drove the discovery phases of Cadia, which is the big porphyry in Australia and in this belt, 50 million ounces greater than that gold, over 10 million tonnes containing copper. It's really the prize in this belt. And through that discovery process, John really knows this belt like the back of his hand. And he was a key figure for why we picked up, say, the Ningen project. That's a project that John first was involved with back in the 1980s, 1990s, and he's been keen to pursue that northern extension of the belt. And now with AngloGold Ashanti, we've got the technical backing and capital to really pursue that aggressively. So John's, I guess, on the board. He's chairman of our technical committee. Peter Leaman's our VP of exploration. Peter's been involved with a number of big discoveries. Probably the best one known is Reko Diq in Pakistan. So there's a team there that have found tier one projects before in the copper gold space, and I guess know how to systematically explore, and that's really the driver in terms of the team. We've got a good board. The board represents 40% of the shareholder register. It's about 10% owned by board members itself, but the two biggest shareholders are represented on the board as well.
Okay, and how much does the board or the management team put into this thing?
Over the course of the journey, it's a fair bit. I mean, say, for example, Peter Leaman, he's been with us since 2016. He's never taken a cash salary. He's only ever been paid in shares. So when you look at what the teams put in from actual dollars plus sweat equity, you'd be looking at sort of over $1 million over the course of the journey.
Without sweat equity, into how many actual dollars? Because obviously everyone's got a bunch of different jobs and different ways of, bringing in income. Is this everyone's only gig?
No, I mean,
yeah.
Say, for example,
how many dollars have gone in? Because I think that's a real kind of telling thing of like, right, I absolutely believe in what we've got, or believe in the model, and obviously, even if you kind of put it on this current version of the company, how many dollars have actually gone in?
Well, dollars in terms of this change in model towards the project generator model, there would have been $500,000 worth of dollars from the board collectively go in since we've made that pivot in strategy.
Right, and your message to shareholders is going to be what, because people need to understand what they're in for here. This is going to be a kind of, well, it's clearly not going to be a sort of a quick return. It's a get rich slow type of scheme. Nothing wrong with that, but just be clear about what it is that they need to believe in or understand from you, so they don't get disappointed further down the line.
Well, with exploration, Matt, we all know one hole can completely change things. But I guess without that amazing discovery hole, the key things are seeing some initial encouragement from these 7,000 metres of drilling that's just taken place, seeing the next amount of committed capital for the 2025 budgets, and seeing the next couple of deals come through. And again, hopefully those deals are more scalable and really show to the market these guys have got to that stage where we really know what the business model is.
Right. And in terms of like the holding costs on the portfolio, is it quite reasonable? I don't really know the area that well.
Yeah,
so
no, the holding cost isn't too bad. We, in the last period of time, did a deal to divest of our Mongolian assets, which streamlined the holding costs of the business. So if we can get to a scenario where we've got sort of $1 million worth of management fees that come in, then we're more than covering G&A and holding costs of the portfolio.
Okay, understood. Well, look, and like Sam, that's a good kind of overview. Like we'd not spoken or met before, so it was interesting to understand you and your thinking, and where the board's going, and clearly the business model I think is becoming quite popular, and hopefully more people understand it. Because quite frankly, junior mining these days, something's got to give, something's got to change.
And I think with
you guys
that,
do what you do.
There's a real thematic that we're seeing, and I know a few other juniors are seeing this as well, and probably starting to position themselves. Is you've had the majors, particularly the gold majors, making good money. The price is good, the margins are pretty good. They've been trying to buy producing assets as you normally do. If you start pursuing growth, you want to get production. It's a relatively crowded space for what they want, and those assets are being bid up and they're becoming expensive. What a lot of those majors did last commodity cycle was get rid of earlier stage greenfield exploration. What you're now starting to see is some of those deals starting to take place where they want exposure to trying to find new discoveries, and they're at that point where the reasons why they stopped greenfield exploration last cycle have got worse. Finding good people, lead times, permitting, ESG, all those things. So what you're increasingly seeing is relatively generous deals where those majors are willing to give the junior quite an attractive scenario and actually fund that risk of making a discovery and giving these management fees or placements at premiums to try and encourage that. Because if you find a tier one asset, and obviously the odds are never in your favour, but if you do, everyone's going to do really well out of it. And there's the realisation that the juniors are better at that in the big end of town. So that's the part of the market that we're trying to sort of position ourselves for. And within New South Wales porphyries, you've had 5 deals over the last 2 years that have supported over $300 million of risk capital and exploration expenditure going into the ground to try and find new discoveries. So that, again, is, I think, a market dynamic that is different to last commodity cycle. That is, I guess, what we're trying to tap into. And on the Australian market, generally those earn-in deals are pretty punitive for the junior doing the deal. It's sort of not a win-win, while that more Canadian, North American market deal structure is where people are more aligned, and that's where the AngloGold Ashanti deal with us for Ning and Nevertire and with Inflection for that part of the belt, and even Goldfields recently coming back into this district provides really good roadmaps for what we're trying to do with these remaining 7 porphyry projects.
No, I agree with all of the above. I really do. It's tough out there, and make this new paradigm we find ourselves, a junior explorers find themselves in, you know, you're going to have to try and take control of that situation. So, love hearing the story. Appreciate your time today, Sam. Stay in touch and let us know how you get on this year, okay?
Definitely will. Thank you for the opportunity, Matt.